President Trump dropped a bombshell on the global economy, sending shockwaves across financial markets and igniting fears of a full-blown trade war. On April 3, 2025, he announced sweeping tariffs on imports from all countries, marking a significant escalation in his protectionist trade policy. The tariffs, ranging from 10% to 54%, target a wide array of goods, from cars to electronics. This move has drawn sharp criticism from world leaders and business groups who warn of dire consequences for the global economy. The tariffs are a cornerstone of Trump's America First agenda, which aims to protect American jobs and industries from foreign competition. The administration argues that these tariffs are necessary to address unfair trade practices and reduce the U.S. trade deficit. However, critics contend that they will harm American consumers, businesses, and the economy as a whole. The announcement sent a chill through global markets, with stocks plummeting across the board. The Dow Jones Industrial Average experienced its worst day since the pandemic began, plunging over 1,400 points at one point. This move reflects the deep uncertainty and anxiety surrounding the future of global trade. The tariffs mark a significant escalation in trade tensions between the United States and its trading partners. The world now waits to see how this high-stakes gamble will play out and what the ultimate cost will be for the global economy. The Trump administration justifies the tariffs on the grounds of protectionism and reciprocity. They argue that American industries and workers are being unfairly disadvantaged by foreign competition, and that these tariffs will level the playing field. By imposing tariffs, the administration aims to encourage domestic production and consumption while reducing reliance on foreign goods. The calculation of these tariffs, however, has raised eyebrows. Rather than a flat rate, the administration opted for a complex formula based on each country's trade surplus with the United States. This approach, critics argue, unfairly targets countries that export more to the U.S. than they import, potentially sparking retaliatory measures. The administration contends that these tariffs are a necessary tool to force trading partners to the negotiating table and secure more favorable trade deals. They point to the renegotiation of NAFTA, now the USMCA, as an example of their success in using tariffs as leverage. However, this strategy carries significant risks, as it could lead to a spiral of protectionist measures and ultimately harm global trade. The use of tariffs as a bargaining chip is a risky strategy. While it might yield short-term concessions, it could also damage long-term trade relationships and disrupt global supply chains. The world is now watching closely to see if this gamble will pay off or backfire. The announcement of sweeping tariffs sent shockwaves through global financial markets, triggering a massive sell-off and erasing billions of dollars in value. Major stock indices around the world plunged, with the Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite all experiencing significant declines. This reaction underscores the interconnectedness of the global economy and the fear that a trade war could derail global growth. The sell-off was particularly pronounced in industries heavily reliant on global trade, such as technology, manufacturing, and energy. Apple, for example, saw its market value plummet by billions of dollars as investors fretted over the potential impact of tariffs on its supply chain and sales in China. The sharp decline in stock prices reflects growing concerns about the potential impact of a trade war on global economic growth. A trade war could disrupt global supply chains, increase prices for consumers, and dampen business investment, ultimately leading to slower economic growth or even a recession. The market reaction to the tariffs is a clear signal that investors are deeply concerned about the potential fallout from a trade war. The question now is whether this reaction will be enough to persuade the Trump administration to reconsider its course. While the Trump administration argues that the tariffs will protect American jobs and businesses, economists warn that they will ultimately harm American consumers. The tariffs are expected to lead to higher prices for a wide range of goods, from cars and appliances to clothing and food. This increase in the cost of living will disproportionately impact low- and middle-income households, who spend a larger share of their income on consumer goods. The Tax Foundation estimates that the tariffs will cost the average American household an additional $2,100 per year. This figure represents the increased cost of goods and services due to tariffs and the indirect costs associated with a potential slowdown in economic growth. The tariffs are also expected to lead to a decline in U.S. imports, as businesses and consumers seek out cheaper alternatives to tariff-laden goods. This decline in imports could harm American businesses that rely on imported inputs, and could lead to job losses in sectors such as shipping and logistics. While the tariffs are intended to protect American jobs, they could ultimately harm American consumers and the broader economy. The increased costs associated with tariffs and the potential for retaliatory measures from trading partners create significant economic uncertainty.